Back to the market, we have our next guest joining in. Rupen Rajguru, Head of Equity Investment Strategy at Julius Baer, is with us now. Rupen, great to have you on. So the market's been kind of, it's been a slightly disappointing day for the bulls because we had a flurry in the middle of the week where the market was taking aim at higher levels. We had 23,000, almost 700 on the screen. But there's not been much follow through. And now we've got both the, the stimuli, the fiscal as well as the monetary today. Where does it leave the market trajectory? What's your call?
Yeah, hi. Good afternoon, Surabhi. No, in fact, as I spoke with you last time around, this will be the year of consolidation and contra. So we would want the stock market, which was in a relentless bull run between 2020 and 2024, to take a pause. So earlier what was happening is that every positive news used to get amplified and used to get rewarded, and people used to ignore negative news. As we speak, what's happening is that any negative news gets amplified and any positive news gets easily forgotten. Why is this happening? Two reasons. One, if you look through, at the end of the day, what does market look into? Market look into the earnings growth, and then it looks into valuation. So on both the accounts, we definitely require a pause, and hence I said consolidation. While you're absolutely right that the economy, which is witnessing, I would say, a little bit of cyclical slowdown, with all the measures, be it on the budget side, to boost the consumption, as well as by the RBI by a rate cut today, will help the earnings grow, but it will happen probably after a lag of 4 to 6 quarters. Till such time the earnings growth doesn't catch up, I think we would be into the zone wherein probably at every rise there will be some bit of selling which would be happening, and that's why probably market will remain in this range.
Okay, all right. Hi, Rupen. Good afternoon. Good to see you, Win. What are the top sectors, though, you're betting on? I think you were fairly positive on financials, banks, insurance. Tell us more. And try to give us a hint in terms, if you're talking about banks, then what do you like from the banking space? The larger names?
So hi, afternoon, Nigel. In fact, if you look through the entire correction which we witnessed in January, banking and to some extent IT were the sectors which were probably, so to say, the best performing sector. And from a standpoint of valuation, definitely banking is the sector which is trading at a valuation which is much lower than its historical average, and also vis-a-vis the Nifty, it is trading at a much lower level, both on the earnings and the price to book side. And we saw through the results, I think a lot of the big boys, be it the largest private sector or the largest public sector banks, they have demonstrated that the margin pressure is there, but not as much as what street has expected, and at the same time the asset quality, specifically on the retail side, I was also very positively surprised by the way the largest public sector bank, the retail credit stood out. So the underwriting skill also is far superior. So in uncertain times wherein growth is difficult and the credit cycle is probably not on your side, we would stick to the largest players out there, in that segment. So that's the segment. Secondly, yes, insurance is a sector which we like. And the life insurance companies, while there was a lot of regulatory noise over last probably many quarters, we believe majority of the regulatory noise is now behind us, and the growth numbers have been pretty strong. And here, what are the type of companies we like? Companies which have a good, decent product set, has a very wide distribution network. So a lot of the insurance companies which have a strong banker partners. And at the same time, now if you look through, the non-par products, which is a high margin product vis-a-vis the ULIPs, with this rate cut which we have seen, the relative attractivity of those products will come back. And we believe that over next year, a lot of these companies will have some of these products which might kind of contribute meaningfully to their revenue, which will be aiding their margins as well. And also the protection growth is pretty strong. So all in all, insurance is a sector we like. And finally, I would say consumer discretionary, particularly after the kind of fillip which we have seen. And if you look through in the budget, the maximum delta will come to people who are earning between 12 lakh and 25 lakhs. And that's the bracket wherein, will be having more money at their disposal. While they can consume, they can also save and invest. Here, the companies which are in that segment, be it the hotels, be it the QSRs, and to some extent jewelry companies, all will benefit from that. So I think consumer durables as well. So that's the segment which we like, particularly after the budget boost.
Okay, all right. So, that's a thought. So, Rupen, leave us with some ideas. It's a difficult environment, slightly confusing, tough market. What would your biggest overweights be? And if you were to deploy some money now, first of all, would you go all in? Would you stagger it? And then the themes that you're most confident on for, say, the medium term, at least the next 6 months to 1 year.
So, Surabhi, in the current context, frankly, if you ask me, is there like a no-brainer buy or a sector or a theme which kind of looks completely like, decimated and, worth warranting a buy? The answer is no. But at the same time, within the sectors also, and hence when I said the two themes, one is consolidation and second is contra. So within each sector, there would be stocks which are trading, probably at like within banking also, there are a lot of private sector banks which are now trading at say a 1P multiple, one price to book multiple over next FY27 book, closer to that. So when the environment improves, historically, those were trading at a closer to two multiple, now at one. So those are attractive. Within pharma also, if you see, there are some companies on the CDMO side which are looking pretty interesting, very high growth. That looks good. And, difficult to pinpoint a particular sector per se, but one segment, which is beaten down, probably seeing some recovery, I would say, is chemicals. So post-COVID, I think, all these stocks had variety of issues, be it issues around higher raw material prices, higher inventory, China dumping, and all those they have seen through those cycles. And probably this quarter we have seen the earnings probably growth to be pretty good for them. And that segment is something which we believe can see a little bit of re-rating because it has seen a significant de-rating over the last 3 to 4 years.
Okay, all right, Rupen, appreciate you joining in. Thanks a lot for giving us your view on markets and all those stocks and sectors that we did discuss. Have a good Friday evening.